The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
Now let's check out where the markets are at. We got, let's see, the S&P looks like it's down just 0.28%. Basically, most of the index is doing the exact same thing. You got oil up 0.5%. You got natural gas flying up 2.68%. And most of the currencies are looking pretty flat right now. And what we want to do today is go ahead and go over a few things and make sure, you can always call in. If you have any questions as I'm going over things, definitely love to hear from you. Love to answer your questions. And so all you got to do is dial the number right there, 1-877-927-6648. Or you can call in international. You can call in 727-445-1044. And what we're going to do today is we're going to talk about Nadex. And let's go over to TFNN.com. And over on the right side here, you're going to see a Nadex banner. Click on that banner, and you can actually sign up for an account. Just click Create Account. You can sign up for a live account, so only $100 to fund it. And you can sign up for a demo account and have access literally in the next few seconds. So go ahead and click on that, fill that in. They'll send you an email, and you can log in. But that's basically how to get an account. But what I want to do is just go over some basic explanations of some things. And I know this is new to a lot of people. And so I thought we'd do a little bit of a presentation format and just walk through step by step. And I want to teach you about, where does the spread value come from? What's the spread risk and reward? How do you calculate spread profit and loss? And how does spreads settle? And then go into maybe a couple examples on exactly how they work. And then we can go over and we can look at some live markets and some live possibilities on trade setups. So looking at spread value, you go in and it's pretty simple. They have basically three spreads inside the platform. So there's a tiered spread. There's a top, a middle, and a bottom. And let's say the market, was sitting at 1335. Then what they would do is right before that spread opened, about 10-15 minutes before the spread starts to trade, then they would post three different spreads. They'd have one that would be 1335 up to 1365. They'd have one that's 1335 down to 1305. Then they'd have one that straddles, basically 15 points up and 15 points below. So it's always going to be 30 points wide. And depending on how long it is till the spread expires will determine how wide that spread is. And you can go over, and it's really helpful if you ever want to see how wide they are. You can literally hop over on Nadex.com and go to Range of Markets, and then just go down here and choose your market. So stock indices. And you can go to Contract Specs. So once you click on that, then you can scroll down, and if you go down where you see spreads, and say find the US 500, and you can see right here that it says that what they'll be is they'll be 30 points wide if they're one of the 8.5-hour spreads that starts early in the morning here at 8 a.m. Eastern Time, goes to 4:15. Okay, so 30 points wide, and that'd be 300 ticks wide. And so what is at every time, what's going to happen is there's always going to be three spreads that open up. There's going to be one that's 30 points below, one that's 30 points above, and one that's straddling at 15 points up and 15 points below. And that's constant. Now, a lot of people ask, why do they do that? Well, the reason that they do that is throughout the trading day, markets move up and move down, and you're trying to figure out really, where's the best trade for you. And depending upon what kind of strategy you're using, you may want to say if you want to buy, you may want to buy one that's lower to the floor. And so you're going to want a spread that's down here. Well, if the market moves up a certain point, well, then maybe that spread no longer is going to be a great risk reward for you. And so since new spreads are coming out literally every hour, then you can go in and you can find new spreads that have closed floors and ceilings, which helps you lower your risk on the trade, depending upon what direction you want to trade. So it's a lot of different trading opportunities, and they last anywhere from 22 hours and 15 minutes down to as little as 2 hours. You can get in anytime after it starts trading, and get out anytime before it expires. So you got the tiered spreads, and then you also have what's called the daily spread, or the master spread, really. And the master spread is going to be really wide. So like right here, this one right here is going to be 80 points wide. So it's going to be 40 points above the market and 40 points below the market. That's called the master spread. And it'll actually trade very on par with the underlying market. And it's sort of cool. You can go up here if you're ever wondering what market it mirrors. Like you can see US 500. Well, the underlying market is the CME E-mini S&P 500 Index Futures. And it'll say, what month it's mirroring and everything else when you're looking inside the platform. So if we go over here to the Nadex platform, we go to Indices Bull Spreads. We click on US 500, and you can pick any time frame you want. So if we chose like the 300 tick wide spreads, they'll be updating this to say 300 ticks soon. And you'll see right here that they're all going to be 30 ticks, so 1335 to 1365. That's the one that's straddling the market. You got 1320 down, or 1350 down to 1320, and then you have 1350 up to 1380. Okay, so it's 30 points wide. Every time that spread opens, that's how it's going to work. And you can go over here to daily, and you'll see the master spread. And the big advantage of the master spread is you can always open it up, click on the chart button right there. Again, that's right there. And on that, you'll be able to actually use this as a great way. If you don't have futures charts, then you can save yourself a lot of money by going in and using these to begin with. And as you get more into it, I definitely recommend that you get a full-on trading platform with a live futures data feed. But you can go in here and you can actually look at the futures charts. And what this is going to do is this is really not going to be the underlying future, again, it's the master spread, but it's going to be very close to where the futures contract is trading. So if we go over and we pull up an S&P 500 futures chart and look at where the market's trading right now on that, then we'll be able to see that they'll be very close. It's 1347.6, 1347.5. So it's sort of it's a cool way to go in there and take advantage of their charting platform if you don't have futures charting capability yet. So again, I highly recommend you do get that, but it will help you in the meantime. And they have a lot of features in here that you can take advantage of. You can change your time frames. You can even go down to 1-minute bars. And again, this is of the spread itself, so it's not actually the underlying market, but it'll be very close. Oftentimes it'll be very close to where the underlying market is currently trading. All right, so we understand that there's always going to be 3 that come out basically on every single time except for the master spread. You'll always have 3 spreads. They'll be tiered. You'll have a top, a middle, and a bottom. And the top one, of course, if you want to buy. The bottom one, if you want to sell. And the middle one, there's a lot of different strategies, but one of them could simply be if the market comes down to here and you're ready to get in and buy. Maybe you think the market's about to reverse. Well, then now you have that middle spread, so you have a lower risk on the trade. And to go into that, to really make sure you understand and fully grasp what the spreads are, then you look right here, US 500, so that mirrors the S&P 500 E-minis. And again, if you ever don't know, just go over to the contract specs page under range of markets, and you'll see right here, it'll tell you what market it mirrors. Okay, and that's really important because a lot of people go in, like they'll trade Forex, they'll be looking at the Forex futures. And though you could use that, you got to understand they're going to be a little bit differently priced. So the Forex is going to mirror the Forex spot market. Okay? Well, once we understand that, okay, that's a September futures contract. So, whenever you're looking at your chart, make sure that you are looking at a September futures contract chart. Don't be looking at, the Decembers or something like that because, it'll look off. They'll be a little bit different. And then your ceiling is going to be right here. So you got your ceiling, which is on the right side, and your floor, which is on the left side. So 1335, then 1365. So you can see right there where that works, how that works. And once you understand, okay, this is a floor, this is a ceiling, I mean, you're halfway there, okay? It expires at 4:15 Eastern Time. All times on the Nadex Exchange are going to be in Eastern Time. So it's going to expire right here. Now, this chart is a Central Time chart, but even if I'm in Central Time, I need to draw it to say 3:15 Central Time, so I know that it's going to go to 4:15. And again, what I like to do is I like to actually draw my spreads on the chart. So as I'm trading it, it helps me keep track of them, lets me know where they're at in relation to the underlying market. There's just a lot of advantage to doing that. And there's different ways that you can do it. You can go in here and just right click, usually on most charts, and there'll be some sort of drawing tool, and you can go in and you can find rectangle. And then you go to just go in there and draw your rectangle, and you can usually click on it and edit it and put in different properties so you can get it specific to that spread that you're trading. But you can put the spread on there. Well, once you know what the floor and the ceiling are and what the expiration time is, and you're looking to get in here, well, then you actually have the box, and that's why I call them box spreads, because they really are a box. This really defines how much you can make or lose unless you're doing what we call the open box strategy. We'll be discussing that later this week about how to open up this box and not have a cap on your profit by combining it with the underlying market. Well, to get the spread's value, what is this box worth? Well, what it's worth is going to be 30 points. So, if you think of traditional points, like I said, they'll be updating the Nadex site soon to say ticks, but 30 points. So if I do 1365, the floor, or the ceiling here, minus 1335, the floor, then I'll have 30 points wide. So it's a 30-point wide spread. So when we looked up here, there's 130 points above, 130 points below. That's how they figure that out. Okay? Every single tick on Nadex is worth $1, no matter what market it is, whether it's oil, the S&P, the euro dollar. It doesn't matter if it's the Nikkei, whatever it is, it's literally going to be $1 per tick. So if it's 30.0 wide, it's 300 ticks. If every tick is worth $1, then that's a $300 spread value. And if you haven't caught our other shows trying to figure out what ticks are, it's really simple. The last decimal it's quoted in is always going to be the tick, okay? And it's always going to tick in increments of 1. So 0, 1, 2, 3, 4. There's no quarters and eighths of a cent, nothing like that. Nothing like that you got to worry about. So every one of them is always going to be the last decimal place, always moving in an increment of 1. And it's really simple to see if you just look at how even the spread's quoted, 1350.0. Well, then you know that that last decimal place is your tick, okay? And if it says, it's 300 wide, then it's $300 wide. Well, first you have to know how wide it is, just so you can do your basic math there. Well, you go in, once you understand that, and again, there's no calculation required. It tells you 300, so that's $300 value spread. These are $100 value spreads. These are $400 value spreads, $800 value spreads. And they have all different spreads, all different values, depending upon what market it is, and that amount is automatically set. So that's on that contract specs page. So over here you got $1,000 wide spread. So you have a lot of different spreads that you can check out. Well, now that you understand that it's a $300 wide spread, let's check out what the max risk and the max reward is, okay? Well, if I went and I decided to buy this spread, for instance, at 1337.6, then my max risk is going to be from 1337.6 down to 1335. That's the most I can lose. No matter what happens, I can't lose more than that. So all I got to do is know, well, what is every tick worth? Every tick's worth $1, and I just have to do some really basic math. 1337.6 minus the floor, which is, again, right here. Okay? 1335 gives me 2.6. So, and if I go and I get rid of that decimal place, I know I have 26 ticks. There's a $26 risk. And again, I can see that right here. If you check this out, as soon as I open a ticket inside the Nadex platform, so over here, if I go in this, and we click on, we'll say buy on this one. And it'll automatically calculate the risk. So like the risk on this trade right now is only $13 on this trade. And it's doing the math for me. So just so you know where the math comes from, it's sort of important to understand that so you don't just feel like, I don't know, they just said it's $13 risk, so I guess that's what it is. Well, that's how they got it. So they just took the price you bought at minus the floor when you buy it, and that difference gives you the ticks. Every tick's worth $1. It's $26 risk. So it really is that simple, okay? And then go in there, margin capital required. This is really great, $26. So whatever your risk is, that's also your margin. So if the risk is $500, then your margin is $500. If the risk is $26, your margin is $26. So per spread that you're trading. And it allows you to go in with a really small account and start trading, learn how to trade them, get comfortable trading them. If you're new to trading, it gives you a very defined risk way, so you don't go into like a futures market that has undefined risk and get wiped out really quick. And that's really one of the biggest benefits on Nadex. Now, if we go in, before we even look at the spread reward, I want to make sure we do definitely point something out. And over here, no matter what happens, let's say the market just falls down here to 1320, and then it comes back up before expiration, then what would happen on that is we literally would not lose any more than our maximum risk, which is $26, but we also won't be out of the trade. So you're down, but you're not out, meaning you have until the trade expires at the end of the day at 4:15 before you're out of the trade. So it can literally go against you. You won't get whipsawed out, and you have time to come for the market to come back and go in your direction. So that's really just a huge benefit when trading Nadex, is you don't have to worry about their stop losses and everything else. So, all right, well, when we come back, we're going to go into how to calculate the reward on the spread and exactly how that works. So, again, if you have any questions, please make sure to call in. Love to hear from you. We'll answer any questions you got and just walk you through it step by step. Let's see here. So you just go over here, and if you don't know what it is, just click on Listen Live. You can see the number right there. All right, well, I will see you. Stay right there. We'll see you right back after the commercial break.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pesavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, everybody, welcome back to the Diagnostic Trading Hour. Darrell Martin. I want to go ahead and we just talked about risk, and one of the questions that came in was, what happens, does the platform, NetEx close out your trade automatically at 4:15 when the spread expires? So that way, if you're not around to take a profit or loss, just basically how does it work? What happens? Well, what actually does happen is it settles at that time. We're going to go into that in detail. And yes, it automatically, instead of closing the trade so much, which is great because they don't close it in the sense, but they do settle it. So once they settle it, then it'll automatically calculate your risk and reward based on where the price is at expiration. So we'll actually go through a couple examples on that. That's a great question. So right here, let's check out the reward and how that works, and then we'll come back and show you exactly how settlement works as well before the show is over. So what we're going to do is, on this, if we buy the spread at, let's see, we already got the risk there, so let's go to spread reward. So if we buy the spread at 1337.6, then my profit potential is all the way up to 1365, okay? So I have very defined risk, and I have some reward there. And again, the ticket will automatically calculate your maximum potential loss and your maximum potential reward. And it's really simple. You just sort of take a different piece of the formula. Take where you bought the spread at. So I bought it at 1337.6. So you can see that's the price that's in here. It's the price it's quoting at right now on, from this screenshot here. I know the market's up a little bit, obviously a little bit higher than that at the moment, but just to give you an example. So 1337.6, if the market was at 1337.6 right now, when I got in the trade, then I would simply subtract it from the ceiling. So I'd subtract it from the ceiling up here. It's also like everywhere on the platform. You're going to see floor and ceiling. So 1365 minus 1337.6. The difference on that is going to be 27.4. All right, so that's just taking 1365 minus 1337.6. And when we go in and we do the math on that, we got 27.4. Just drop the decimal. It's really the easiest way to do it. You can also divide by 0.1 if you want to get all. I just like to get rid of the decimal. There's no math required. 274 ticks. Okay, well, every tick is worth $1. So therefore, the actual maximum profit there, I got risk on there, the actual maximum profit on there is $1 per tick, and that gives me a $274 potential profit on the trade. Okay, so I can make $274 on this. The most I can lose on the trade is $26. So the most I can make is $274. Now I won't make that $274 unless it's at or above $13.65, but that's the most that I can make on the trade. So you have a huge risk-reward potential in your favor. So one of the things we did talk about a little bit ago was whipsaws in the last segment. And I just want to really make sure that everybody understands what a whipsaw is. And a whipsaw is really when the market spikes in the direction against you. Okay, so you get in, you say buy, all right? The market spikes against you, and you're being a good trader. You have a stop loss on there. It stops you out. It knocks you out of your trade. And by hitting your stop loss, you're out, but then it goes right back in the direction you're going to begin with. And you're just sitting there like frustrated because you're like, I knew I was right. It got stopped out. Should I get back in? And you have all these. Now you have to deal with, do I get back in? Do I get back in the same direction? Do I just go in a reversal on that trade? What do I do? You have to deal with it because now you've been knocked out. You've lost that money. You don't have a chance to make it back without putting more capital at risk. Well, with all the products on Nadex, you have until expiration to be right. Therefore, you're not ever going to get knocked out. So, for instance, over here, let's say we had a stop and we were trailing the stop up. We got in and we had our stop, just let's say at this bar right here. We're trailing it up. And the market just came down, spiked against us. Well, we'd still be in the trade. Whereas if you had your stop loss right here, you'd have got stopped out of the trade. And, the spikes can be huge. This is just a small example. And we'll show some Forex examples coming up this week and looking at, what would happen on a Forex trade. And this is just an example on the S&P 500 E-mini futures using the US 500 Nadex spreads. So it's great. You have that defined risk. You don't have to worry about getting whipsawed. You have till expiration to get right. And, it works really in your favor. So with that profit, you can close at any time you want to before expiration. Okay? So whatever, you can close it here. You can close it at any point you want to. And that's a big benefit. A lot of people think they get in and it's like, okay, that's my risk and my reward and that's the trade and that's it. No, that's your risk and that's your reward. That's your maximum. But you could take on the profit sooner. So maybe when it starts coming back, you might get nervous and close out. So things like that. Or maybe you have 5 or 10 contracts and you take off 5 once you've maybe doubled your risk. So, at double, remove half. And then the other half you let ride to see if it keeps going, knowing that you have very defined risk on the trade. And so, again, anytime you wanted to. So when it spiked up here, you could have got out, or up here you could have got out, or maybe it starts coming back down, you don't want to take maximum loss, you could have got out there too. And here's what's going to happen. This is sort of an interesting thing, is when the position settles, you're going to get a ticket literally within seconds of it closing out. So if it's at 4:15, you're going to probably get it, before 4:16. And I mean, literally, a lot of times I see them with literally just in seconds. And I have all my emails from Nadex actually going directly to my text messages, so that way I can see my tickets without even having to open my email up. Well, they're going to send that to you, and they're going to say that your contract has settled out, and the quantity you had here, in this instance was 1. The expiration value was 1340.65. So basically, that's right where the market was at after they do the settlement formula, and we'll talk about that here in a second. All right. Well, we're going to come back. We're going to go into exactly how that expiration settlement works and that payout works right after this break. If you have any questions, give us a call, 877-927-6648.
Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of tfnn.com. Futures and options trading involves risk and may not be appropriate for all investors. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, everybody, welcome back to the Diagnostic Trading Hour. When we last closed out, we were talking about how to calculate risk and reward and how it works. So now we're going to talk about expiration and settlement and go into a little bit more details. When your trade settles out, you're going to get a ticket from Nadex. It's going to look similar to this. And what's going to happen is it's actually going to go in, and it's going to say, hey, if you have any questions, give us a call, but this is what your trade settled out at. It settled out at 1340.65, so like right there, okay? And then it'll tell you your payout amount. And your payout amount is, you really got to make sure you understand what the payout amount is, because if you don't, it can sort of, trip you up a little bit. Payout amount is really simple. All it's doing is saying that's how much they gave you back. Because remember, what happens is every trade on Nadex is fully collateralized. So if we go back and we look at what your risk is 26. So if your payout amount down here was $56.50, then, we'll zoom in on that for you, $56.50, then what you'll know is, okay, so that's what I got paid back, but I also put up margin. I put up the risk capital, okay? And what they did, the way they figured out what your payout amount was, they took where the spread settled at, 1340.65, and they took the floor strike, which was 1335. Remember, that was our floor strike on this spread. The difference on that, 5.65, and that basically gives us 56 ticks or $56.50 as a payout. And that's why they said the payout amount is $56.50. So how much of that is profit? What you do is you take your payout, $56, minus your risk, which in this case was $26. And that's your actual profit, $30. So you made $30 on a $26 investment, okay? And you were able to actually get a return on investment of 115% on this trade. And that's how the trade worked out. It's pretty simple. Go in there. Now, what if you lost, okay? So let's look at the bottom spread. So let's say instead of buying here, you sold here and you held it to expiration. And the bottom spread, remember we got tiered spreads. We have a top, a middle, and a bottom. The bottom spread was from 13.35 down to 13.05. So all the way down there. And what we're doing is we're trying to figure out really what, the best, strategy is on this. But more than anything else, you want to figure out, just make sure you understand the mechanics, and that's the strategy of the trade. So how does the trade work? How does the risk work when you sell the spread versus when you buy the spread? So when I sell the spread and I go in here, then what I know is my risk is going to be where I sold the spread all the way up to the ceiling. Okay, so the ceiling being 13.35. All right, we know our spread width is the same as before, right? Because it's always 30 points wide on the ones that start at 8 and go to 4.15. So it's going to be 13.65 down to 13.35. And again, you don't even have to memorize that. That's right on the NateX platform. Tells you it's 300 points wide. But that's 30.0, 300 ticks, every tick worth $1. So it's a $300 spread value. So basically my risk and my reward are going to total combined $300. So if I sold the spread at 13.34 and the ceiling is 13.35, then I simply minus those from each other. So if we do the math on that, we do 13.35. Okay, that's the ceiling of the spread, also the ceiling you saw here, minus where we sold the spread, 13.34. Okay, 1.0. Well, we get rid of that decimal place. We have 10 ticks. Every tick's worth $10. Therefore, we have a maximum risk of $10 on this trade, and we want to put up $10 to trade it. Okay, we have a $290 profit potential on this trade. So the risk really works the exact same way, except for when you just flip it the other way. So instead of being where you bought it minus the floor, it's where you sold it minus the ceiling. And again, you don't have to do any of this math. I just want to make sure you understand where it's coming from, because people can be like, why is that my profit and loss potential? So that's how you understand how that works on the ticket when they're showing you $10 and $290. They're automatically doing it for you. As soon as you open a ticket and put in quantity of 1, you're going to automatically see the profit and loss. And if you put in 10, you're going to see the profit and loss potential on 10. So we go in there, and if we sold the spread at 13.34, then what was our profit potential? Okay, it's going to go all the way down to 13.05. Well, down at 13.05, then what we know is we have 13.34. That's where we sold, down to 13.05. That gives us a 29.0 risk. And we again, just drop that decimal, make it easy. 290 ticks, $1 a tick, $290 potential reward. That's where they got the profit from. Okay, they just simply said, okay, well, you sold it here. You can make money all the way down to the floor, and that's how you calculate your maximum profit. And so we put all that together, and we find out, okay, well, what happened on this trade? Well, this trade actually went up here, and it expired, as we know, at 1340.65. So on that trade, you're going to get again an email, and it's going to say your payout is $0. So if we zoom in on that a little bit, you'll see $0 is the payout amount on the trade. And how did they get that payout amount? Well, my payout on the trade is going to be, 0 minus my risk. So $10. So I actually lost $10 on this trade if I would have sold it. Okay, if I would have done, say, 5, I might have lost $50 on the trade. And we go in, and people go, well, where do they come up with that 1340.65? Because the S&P doesn't even trade in 0.65, not on the US 500, not on the S&P E-minis. How does that work? Well, box spreads are all cash-settled contracts with the variable payout that allows trading on the expected direction of the underlying market. The payout amount is obtained by reference to the settlement value in the floor and the ceiling. So that sounds really confusing. Basically, what they do is they take the last 25 trades, all right, or they take the midpoints on Forex, so the last 25 quotes on Forex, just prior to expiration. So literally the last 25 trades that happened before expiration on the S&P E-mini futures. And they remove the 5 highest and the 5 lowest. So those weird spikes that can throw things off. You have just one trade that pops up and comes back down. They get rid of those so that way you can have a fair settlement value price. And then they average the remaining 15 spreads. Okay? They then round it off. So if we go in and we took literally took the last 25 trades, took out the top 5, bottom 5, took the remaining 15, added them together, divided them out, then that's how they get it. You don't have to worry about this. They get the data from actual Reuters. So that information's coming in, and they're doing it all, and it's just automatic. Like I said, that's why it happens in seconds. And also, you can go over to natex.com, trade/rules, to see even more details about that and how it works. And again, all the contracts are going to be based on the underlying market. And if you have not closed out the trade prior to expiration, the trade is going to settle. So you don't have to trade. You don't have to close it. It'll settle. And whatever the profit and loss on the trade will be determined by where the market settles. So where is the market right at expiration? And again, within minutes or within seconds, you'll see it. And again, to remind you, whenever you get that settlement payout ticket, it's going to be not your return. So if I put up $20 in a risk and I lost $10, I'd say a $10 credit. So a lot of people see that $10 credit and they're like, oh wow, I made $10. I thought I lost. It's like, well, you did. You lost $10. You got $10 back. Well, if I put up $20 in the spread and I got a payout of $20 because it settled right at where I bought it at, that means I broke even. If I put up $20 on a trade and I made $80 on the trade, then I'd actually see a $100 payout. And that'd mean I got my $20 back that I put up and I got an $80 credit. So the above examples here, they don't include exchange fees and all that fun stuff. And if you want to know how they work, you can go to CME's website. I'm not CME, but you can go to Nadex's website. And it's anywhere between 90 cents and 25 cents. If you want to compare, on just a per contract basis, because you can go really small or you can go larger. The larger you go, the cheaper it gets. Okay, so it could be as low as 25 cents a contract. The CME for comparison, per contract, the smallest you can do is an S&P E-mini future, and that's $1.16 aside with NFA fees and all that stuff built in. Now, the more you're doing, of course, that's going to increase those fees. The nice thing is you don't have all the clearing fees and the routing fees and the platform fees, and you don't have commissions. So again, all the contracts will be settled based on where the underlying market is, and you don't have to worry about that really that much for spreads. Okay, and this is an important thing to point out. Don't really get too concerned about it. I mean, you're going to look at your chart. It's going to be usually just like right where it is. But the binaries, it can be a big difference. And we've talked about binaries in some past shows. We'll talk about them on some future shows. On the binaries, one tick can mean win or loss if you hold it all the way to expiration. So binaries can be really important. But as far as the spreads are concerned, it literally, it's a buck or two, so difference. And to show you just an example of how this works, if we took, these are the last 25 trades on this trade example right here, okay? And we knocked out the lowest 5, and then we knocked out the highest 5 trades. We took the remaining ones, and we added them together, and then we divided them by 15. We got the average. And then we rounded it off out to one additional decimal place, because they want to make sure they round it all the way off, and that came out to 1340.65. And a reminder on FX, they're going to use the midpoint, the mark price of the last 25 bid-ask quotes, and they're going to get rid of duplicate quotes. So, again, go to Nadex's website if you want to get all into that. I really don't get that concerned with it. But so, again, your payout amount, let's say it was $56.50, then that's how that would work. So now we can look at a couple other things just to show you, how does profit and loss work? Because I really want you to get down the idea of profit and loss, when you can get in, when you can get out. So this is an example of just, say, an oil trade. This was, a little bit back, but I just want to give you a good example. And let's say we have a 75 to 80, and that's a spread. Okay, so 75 to 80. And what that means is my spread, I can't lose anything below 75. I can't make anything above 80. Well, let's say I want to get in on this spread when it's priced at 75.25. Okay, that means I'm going to have 25 ticks of risk. So one spread, 25 ticks of risk. And what's my reward going to be? Well, my reward potential is going to be all the way up here. And again, if the market spikes against me, I cannot get stopped out of the trade. Whereas, if this thing came over here and dropped down to 74 and you're trading oil, you're down $1,000 on a full oil contract right here. Okay, if you did 10 of these, you'd only be down $250 on an 8x spread. But it kept going, then came back up. So you were able to actually stay in the trade in this, for this example. And if you stayed in the trade and held it to expiration, even though any oil trader probably would have been knocked out on that trade, you're able to go in and it expired at 75.55. You made $30 on a $25 risk. Not a huge profit, but a great profit as far as your risk-reward ratio and as far as your return on investment. And then you go over here and you can check out some other things, such as what happens if it went all the way up. Because people go, what happens if it goes to 80, like 82, 83, whatever. Well, again, we're going to go over an open box strategy, but on the regular box strategy right here, when you just buy the spread, your profit is capped at 80. Well, still not that bad. Okay, you had a $25 risk on the trade. You made $475 on a $25 risk. And again, you can multiply that times 10, risking $250 to make $4,750 on this trade if it were to go above it. So you may, you lost out on some profit potential, but you also were able to not, in the other scenario, you were able to lose out on a lot of the risk that a normal trader would have had of getting stopped out on the trade. And then we go over there, it could just, just be a zigzag market like this. And you can get out, again, anytime you want to. So maybe you hold it to expiration and it expires at 77. So again, 77, where it settled, minus where I bought it, 75.25. So I made 175 ticks of risk. That's $175 profit, okay? And maybe I sold it earlier. Maybe I sold it at 76.10. I didn't have to hold it until expiration. And on that, if I sold it at 76.10 and bought it at 75.25, I made 85 ticks of profit. So $85 profit. Or maybe I was, I just called it, and it flattened out over here, and I'm like, I need to get out. So I sold it at 78. And at 75.25, It's where I bought it. So I have 275 ticks of risk, or 275 ticks of profit on a $25 risk. And maybe it dropped back down. And so, you could have sold some here, some here, some here. If you had 10, maybe you sold three, 2 here and 1 over here, and you have a couple left. And so at 76.60, I sold out. I bought at 75.25, 135 ticks of profit on a $25 risk. And, some other examples like on Forex, I want to go through just as many examples as I can so you just get this down, and it'll really help us go into the next level where we start really talking about diagnostic trading and how to pick your trade setups. But if we go into pound dollar and check out how the pound dollar works, and, let's just say this is a trend line, and for whatever reason you think that means the market's going to go down based on this trend line. And then we go right here, and we're looking at this, and we go, okay, you know what? If the market comes right up here, I think I'm going to be pretty much ready to sell Forex. And you're trying to figure out what you want your stop loss to be. You're like, this is the last market spike. I'm going to put my stop in the market. This is again trading spot FX pound dollar. I'm going to put just a little bit above that, and 1.57 or 575, and so that's my stop loss. Well, my risk on the trade, if I'm doing spot pound dollar, is going to be $650. I'm going to be putting up over $3,000 to do this trade, and that's just a normal FX trade. So I go in, and the market comes down, and then what does it do? Bam! It spikes me out. And that really hurts when you're a trader. You get in. But what hurts even more when you're a trader is when it does that right after it knocks you out. I mean, it literally just barely knocked you out and then came right back down. And you're like, I knew I was right. You were just right a little bit too early. Should have been right a little bit later. And so that really hurts. And the nice thing is, how can you solve this problem from happening to you again? Because one guy did the pound dollar, another guy did the Nadex pound dollar spot, and how did that turn out? So if I look over here and I decide instead of doing the pound dollar spot, I decided to do the pound dollar on Nadex, then I go ahead and I put my box on the screen, so it's going to start at 2, it's going to go to 10, 8-hour spread, and I have a ceiling up here at 1.57, and I got a floor down here at 1.5450. So I have 250 pips of value in that spread, okay? And I go in and I go, you know what? I'm going to go ahead and sell the spread when it's down here at 1.5665. So when it's starting to move back down, I have no stop loss, okay? Because I have a $35 maximum risk. And I can allow it to spike against me and come back down. So basically my stop loss is my spread ceiling versus having an order that knocks me out, okay? Because it stops my losing, but it doesn't stop my trading. And so I go in and I decide to sell. Now, I don't just sell 1, I sell 10. Well, why would you sell 10? Well, the pound dollar, Aussie dollar, euro dollar, they're all equal to 1 mini lot, okay? So 1 mini lot on spot. And so if you want to do a full lot, 100,000 units of currency, and you want to get that sort of dollar for dollar move, then what you'd be looking at is a $1 move in 10 contracts would be equal to a 1 pip move in a pound dollar lot. And again, this is spot FX, not futures FX. Okay, and again, you can use the charts on there, but it's going to be a little bit different because of what's called carry. But we go in, we sell it, and the risk is $350. The margin is $350. So instead of having a $650, risk and a $3,000 margin, I only have a $350 risk and a $350 margin. Well, it comes down, it comes up, it does not spike me out. I'm down, but I'm not out. Then it drops on back down on the trade, and it settles out. And when it settles out, I'm actually able to make $76 per spread on a $35 risk per spread, and I profit $760 on a $350 risk. So we'll go ahead and we'll wrap this up and look at it and show you exactly how it works, and we'll compare them side by side right after this break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
Catch Tom O'Brien and Steve Rhodes as they teach you the art of mastering money when it comes to trading and investing. The Money Masters, next on TFNN.
All right, this is Darrell Martin. Welcome back to the Diagnostic Trading Hour. Let me go ahead and pull this up for you right here and show you exactly where we're at on this trade and compare them side by side for you. Okay, so now that we got that up there, and you can check that out, we went through the trade, and basically we were comparing the pound dollar by the side by side. Then what you can see here, let me pull that back up, is you can see on this trade, I'll just go ahead and put it right here for you, make it a little bit faster, is that you basically were able to risk a lot less money, okay, doing the exact same trade, and put up less margin, and not get stopped out of the trade. So you're able to risk only $650 on the trade, using the pound dollar spot. Your risk was $350 on the trade using the Nadex pound dollar spread. So you had less risk. Your margin on the pound dollar spot was $3,136. Your margin on the Nadex pound dollar spread was $350. He both did the same trade, getting at the same time, but one got stopped out early. The resulting trade was a $650 loss on the spot pound dollar. Whereas the resulting trade on the pound dollar spread, it was $760 in profit because it did not get stopped out on the trade. And that really is the ultimate value that you're seeing in the entire spreads and how they work, and basically just everything that goes with them, is that you don't get stopped out. A lot of times you have less margin, and depending upon where your stop loss is, you could have a lot less risk as well. And that's really what I wanted everybody to see today, is just to understand and see that you can get in and you can get out whenever you want to. You can hold it to expiration and they'll settle it out. How does that settlement work? How do you calculate risk? How do you calculate reward? And if we put two of them side by side, how would that work out? So that really is the quick, I guess you could say, summary on just how spreads work. And really, it makes a lot more sense once you dive in and sign up for that account. So if you haven't already, make sure you do hop on over to tfnn.com and go ahead and click on the Nadex logo. Again, that's right here at tfnn.com, main homepage. Click on the Nadex logo. Click on this. It'll make it a lot, makes everything make a lot more sense as you're listening in. Hop on and just sort of see, how the spreads work and how everything lines up. Now, if I wanted to go ahead and look at some potential trade setups for our last segment here before we close out for the day, I'm going to go ahead and pull up and just look at, I guess we'll check out oil. That looked like it was, moving for us. And so we'll go ahead and we'll pull up oil. And we got a trade right here. Oil is really just like it is hitting this line. And so you can decide if you wanted to, do you think it's going to break out? Do you think it's going to drop down? And as you can see, it's already starting to break out over here. So with that breakout, you can decide, okay, now what's the best setup? Well, obviously you're going to want to buy a spread. And so you're going to want to see, what trades exist that give you the potential to go in and trade oil, and how long do they exist, and, what's the risk, what's the reward on those trades, and are there any that just really line up with what you're looking to do? You could also look at if you wanted to sell it. So again, there's a lot of different options that you have available to you. And if you wanted to trade oil, you could go over here, and it's really simple. Just right on the left side in the what's called the Finder section, just click on Commodities, Bull Spreads, click on Crude Oil, and then go down and find, you can literally just scroll down through the different ones and see, okay, which one is closest to where the market's trading. Well, the market's right now at 87.83. So if I want to buy a spread, I want one that's pretty close to 87.83, and I may even check out this spread. So if I go in and I checked out this spread to see, what's the potential on that, that's a $24 risk for $126 profit. Ideally, I can find one that's in between the price, because that means that I have a little bit less risk and premium on that. So make sure you do definitely go and check that out. Start playing with it. Again, you don't just have to do oil. You can do corn, and you can do soybeans, and you can do natural gas and gold. You also can check out things like Forex bull spreads and indices bull spreads. So there's a lot of different markets, whatever you're used to trading. Even if you're not a futures trader, if you're used to trading the ETFs, then you can go in and check that out. And you can trade like the spiders. You can check out US 500. So check those out. We'll talk about on one of our next shows the ETFs that line up with different ones and how that works and how you can take advantage of that. Anyways, y'all have a great day, and we will see you tomorrow. Same time, same channel here on TFNN.com.